We all know what capital markets is. There may be a person that does not know that. When you say capital markets, explain precisely how this works.
Rather than a bank underwriting this loan and keeping it on its balance sheet, it's sold off into the market, into the capital markets. And the capital markets take it and structure it and dice it up, and they create things called collateralized debt obligations. It's a $1 trillion market. It's a very big market. Over half of it is subprime.
Subprime meaning people who normally might not qualify to do this borrowing. Is that right, John?
Subprime was essentially brought about 2 decades ago to help people who would normally qualify for home ownership get into a home. You're pricing their risk. They might have a bad credit history or no credit history. And for the most part, it's done well. What has happened is a few things have gotten out of control in the last few years.
Exactly. Now, as you're in your committee with the TRS, did you see any of these things that you had the opportunity to invest in, Dory?
Actually, we saw those, and we turned down, for example, a couple of the Bear Stearns hedge funds that went under. I was very familiar with those, had known them intimately and knew the portfolio managers. But the quote that I'd given them was that you can take this bad credit and you can dress it up with a CDO, but it's still a pig.
If it looks like a pig and all that,
it's still a pig.
It's definitely a pig.
The CDOs are great structures, but they can't fix bad credit.
Exactly. Now, Mike, you've sort of got an academic approach to this thing. Give us some perspective here from your point.
Well, it's careful. We need to be careful not to get overwrought with the current circumstances. The subprime market is a good thing. I think we've already said that there are people out there who, if you give them the right kind of deal, they can get in and become homeowners. It's also securitization is a good idea. It provides liquidity into the market. Those were all positive developments. The excesses are what we need to worry about.
Exactly. When you say excesses, that means there's just too much of it, or are we talking about some fraud here? What are we talking about?
Well, the fraud for sure, and I think you may have other panelists who have better war stories than I do as far as that goes. But clearly there was fraud, there was bad practices on both the borrower and lender side.
Yeah, underwriting, John.
Underwriting decisions got very lax. There people were getting loans that were called ninja loans, no income, no jobs, no assets. People were signing notes that they couldn't repay. Mortgage brokers were steering people toward financing that wasn't in their best interest. The rating agencies, the Standard & Poor's, would look at a big collection of securities and say they're AAA rated, even though they had embedded losses within. There's blame to go all the way down.
All the way around. Now, what's a rating agency, Bob? Tell that viewer what a rating agency is if they don't know what it is.
Well, it's an agency that I've just been learning has been working with the industry primarily to put a credit rating on there that's supposed to be a seal of good approval or seal of semi-good approval so that the public can go on that and not have to do research on its own. It turns out that hasn't worked very well.
Yeah. Dory.
Well, for example, 47% of net income last year from Moody's came directly from collateralized debt obligations. In rating those debt obligations, so you sort of have a conflict of interest.
Dory, they say they're in the Wall Street Journal saying that they're not culpable in this thing. They did not let these fees influence their decision. Isn't that right?
That's what they say, but you got to consider the source.
Well, let me consider graphic number 7. I want to look at that right now. I want to show you what has happened over the past few years since I guess that's about 1971. This is the ratio of median housing price over median family income. And what it means is that we have a whole lot more people buying a whole lot more house than they can afford. Mike, is that one of those problems you're talking about?
That's a problem. Some of what you're seeing there is people essentially buying a lottery ticket with a bad check. They're getting into a house that they can't afford in hopes that the prices will keep on going and then they'll be able to bail out. Yeah. It doesn't work that way.
It's kind of like musical chairs, wasn't it, Dory? Who's going to have the house when the music stops playing here?
Absolutely, it's another bubble.
Yeah.
It's another bubble.
Another bubble.
There's an expression, never confuse brilliance with a bull market. And,
exactly.
Nothing bad had been happening because prices had kept going up and
exactly.
it hadn't been stress tested.